Welcome to More Financial Talk. I'm Ryan Moore, and with me today is co-host Tony Shore. How are you, Tony?
I am doing great today. Yeah, I've had a good day. Thank you so much, Ryan, for having me on your show. I know we've got an amazingly hot topic today that a lot of our listeners are going to want to hear about. But I've been good. I've been really, really busy. We've been doing spring cleaning, and I'm trying to get my garage completely dejunked. We've got about 28 years worth of stuff since we've been living there in the rafters. Some of it we haven't touched in over 20 years, and I'm trying to tell my wife, if we haven't touched it in 20 years, Ryan, we should just be able to give it away or throw it away, right? I mean, we're never going to need it.
I think that's a good cutoff, 20 years.
I think so too. But the wife does, she's like, well, we should maybe look at it. And I'm like, if you haven't looked at it in 20 years, let's get rid of it. Even 10 years or 5. Yeah, I think we should
Yeah,
be able to get rid of it.
all about purging. Just ask my
Oh,
wife. She knows I don't like clutter.
yeah. And it feels good, I think, to get rid of stuff. But,
Oh, it's
and
cleansing, yeah.
yeah, but busy. How about you? How have you been?
Yeah, good. Just I participated in 3 graduations last week between my wife's younger sister and our oldest one, and graduated high school, and our youngest one graduated kindergarten. So
Oh, that's
taking in all
great.
those events and just taken back by how quick time goes by and how quick everybody's growing up and how much more gray hair I've got these days. That's it.
Well, it's good to spend time with family, and it's good to be able to have these stories with family. And I know that's important to you, so that's great. Yeah, my daughter graduated from college this past weekend. We celebrated that. That's one more off the payroll, Ryan. That's how I look at it.
Well, congratulations and congratulations to her. That's
Yeah,
exciting. Now she
it
gets to
is.
get out in the real world. So,
Yes, exactly. Well, what is this let our listeners know about the topic you've got for us today.
yeah, so we are going to touch on annuities, and we're titling this podcast Perceptions versus Realities. And the reason why we talk about it like that, because I think that this is a pretty polarizing topic. I think a lot of people have some misconceptions about how annuities work. And, there's so many versions of these that they're not one size fits all. So there's a lot that goes into this topic. And it's something that we provide for a piece of the puzzle within most plans. So I think it would be a good one to try to drill down on today.
Yeah. Yeah, I think that's really really important as well, Ryan. And a lot of people there are a lot of misunderstandings, I guess is the way I would put it, regarding annuities. I know I didn't get it, and you hear so many competing stories about annuities. It's good to look at reality versus fiction and how they really work. And I know that there are so many different types, and I assume that's where you want to start, right? Looking at maybe what an annuity is and all the different types of annuities?
Yeah, absolutely. So an annuity by definition really is a contract offered by an insurance company. And annuities are not new. These have been around for a long, long time. And my understanding is annuities go back as far as even the Caesar days, where they
Wow.
were used as pension income. And I know that Babe Ruth once upon a time actually owned some annuities. And like most things, whether it's technology or phones or TVs, right, things tend to evolve and improve over time. And I think annuity products are no different. They've really, transformed into quite an investment vehicle. And there's a lot of versions that have a lot of different nuances to them. And I think that can also create a little confusion for folks as to what is the right fit, if there's a fit at all. So with that, I think that it would be, prudent to kind of start by talking about some of the main types of annuities and getting some distinctions there.
Well, yeah, and I think it's a great time to have this discussion and what we should know about them, because annuities can be a useful tool to have in your toolbox, especially to combat market volatility, which we've seen quite a bit of this year. So let's dig into this. Where do you want to begin?
Yeah, so let me touch on what I believe to be the 3 main types and just kind of give a brief, overview. And, mind you, I educate on this topic and I could spend 2 hours and still need more time.
Sure.
just it's a wide arena at this point, and a very big part of our overall industry. So the first one is what we would call a fixed annuity, and a fixed annuity is really like a CD but offered through an insurance company. So when you think of a fixed annuity, it's basically a fixed rate of return for a set period of time, similar to a CD. However, it does tend to be that most fixed annuities offered through insurance companies tend to be at slightly higher rates available than what you would get at a CD at the bank. Another notable difference is with CDs at a bank, if you are investing in after-tax dollars that are outside of retirement accounts, let's say you get 4 or 5% interest on that CD, and you don't take the interest out, you just let it continue to grow. You still get a 1099, that love letter from the IRS telling you that you have to pay taxes on that interest, even though you didn't take the interest. And therefore, when you're growing money in a CD, it is really growing at simple interest and not compounding, which, Albert Einstein once referred to compounding interest as the eighth wonder of the world. So
Yeah.
we want to always try to compound our growth. But with a fixed annuity, as in all annuities with insurance companies, they do grow tax deferred. Now, there are some times where we are not wild about deferring taxes, but in this instance, at least gives you a little bit more tax control as to being able to pay taxes when you choose to take the money out, as opposed to having to have to pay taxes as you go, like you do on a CD. So there's not a whole lot more that really goes into fixed annuities. They really are fixed rate products that tend to pay a little bit better than the banks. But keep in mind, even at today's fixed rates, when you're factoring in your real rate of return, which is the return after taxes, after inflation, you're still really not probably getting too far ahead. So we don't do a lot with fixed annuities. What I tend to find these days is that folks that are getting up there in years, that are more at an elderly age, it might be trying to do a little bit better than what they can do at a bank, might be a fit for a fixed annuity. But that's not by any means the more popular type in today's times.
Sure. And when you talk about a fixed annuity, I've heard a lot lately, especially for people who, a lot of seniors really like CDs at the bank. But again, you can't always get great rates, and the way the interest works isn't great, as you just described. But there's a multi-year guaranteed annuity, or a MYGA. I've heard those are good. That's a great alternative to a CD, right?
Yeah, and that's exactly what we're talking about. A
Okay.
MYGA, multi-year guaranteed annuity, is ultimately the same thing as a fixed annuity.
Sure.
The other thing to be mindful of when we're talking about banks is, some banks will offer annuities, but they tend to only work with one or two different insurance carriers. So they may be sometimes trying to fit a square peg in a round hole. And it's important to know that if you're working with an independent advisor like myself, we're not limited to what carriers or insurance companies that we can align with, so that we are ultimately always trying to find the best solution to fit that particular need.
Yeah, and it's I think one thing people need to know, and you'll probably point this out as well later in the show, but what I've noticed is, in meeting with these carriers now and seeing how it works through your eyes as an independent advisor, it's so competitive. They're competing to get, to be able to help manage your money. So they all want to offer better and better tools and annuities with better terms to compete with each other. And you get to look at all of them and say, I only want to work with top rated companies, because these companies are the ones guaranteeing that guarantee. The claims paying ability of that company guarantees your annuity and the rates promised. And so we're seeing some really good values out there for the consumers right now, aren't we?
Yeah, ultimately, it does help the end consumer when insurance companies are trying to be competitive against one another to earn that business. That's definitely a good thing for the consumer.
Yeah.
But it does boil down to the claims paying ability of the insurance company. And for that reason, we want to make sure that, we're working with highly rated companies that have a longer track record and have good financials. And so that's about, vetting these companies to make sure that they're gonna remain in business. And
Yeah,
but
exactly.
and when you also understand how insurance companies are regulated, they're regulated more stringently than most every institution. What I mean by that is they have dollar for dollar reserve requirements. which means, if you give them $100,000, your 100,000 has to be there. They have to be greater than 100% solvent. So insurance companies by nature are going to be more conservative, and they're parking their reserves typically in treasuries, AAA rated government bonds. And when we compare that to banks, the reserve requirements at a bank are, I believe, 8 to 10 cents on the dollar. So what are banks in the business of doing? They're in the business of loaning out money: auto loans, home loans, business loans, personal loans. And if those
Which
loans
is much more risky.
yeah. So if those loans default and they don't get the money back, that's where the bank could go under. And then what protects you at a bank is FDIC, right? Federal Deposit Insurance Corporation. And on a federal national level, that is a $250,000 protective, limit as it relates to FDIC and protecting against banks going under. But in the history of the annuity industry, I really couldn't tell you where one annuity has defaulted upon. Usually it's insurance companies that are in the property or casualty line of business that can get in more trouble due to natural disasters and things of that nature.
Right. And typically what happens if one insurance company struggles, one of the big ones ends up buying them out, and then they take over all their products and loans. And so this happens a lot. So, it doesn't happen a lot, but if in the rare instance that an insurance company actually goes under, what typically happens then is another insurance company takes over. So it never really goes away.
Correct. And then in that instance, right, in the rare occasion, an annuity is a contract. So you're also protected by contract law. So if there is a company that gets in trouble and another company comes in to take them over, they can't change the particulars of your contract.
Right.
And so we also speak of this when we talk about, IRAs and retirement accounts when it comes to legislative risk, specifically tax rate risk, where they can change the rules on you on these retirement accounts in the middle of the game.
Yeah.
Where you eliminate that when you're dealing with contracts. So you specifically have that contract law protection.
That's good. That's another upside. So that's basically fixed annuities, but that's not even the most popular annuity right now. I know there are even more popular annuities, especially when it comes to all the baby boomers and Gen Xers who are entering retirement, right?
Yeah, and if you don't mind, Tony, let me start with what I think is the annuity category that tends to give all annuities a bad name, and then we'll end with the most popular, if that's
sure.
okay.
Yeah, no, that's probably a better idea. Yeah.
Yeah, and so with that, I tend to, when I meet with folks, many of them have a predisposition that, annuities are bad, or they were told to stay away from annuities. And there's so many versions of these that it's hard that, that there's a blanket statement that can be true in that regard. And also, when you think about the inflows, I mean, literally tens of billions of dollars are flowing into these products every single year. So I don't think it's one big scam going on out there by any means. Now, the type of an annuity that I think tends to give all annuities a negative connotation is the variable annuity. So just by the term variable, think about that. That means that your money or the account balance is varying. So variable annuity is really nothing more than a basket of mutual funds referred to as sub-accounts that have some insurance guardrails around the product. But your money is physically in the market. And so therefore, it's not a safe haven as far as principal protection. So it is designed to be a growth type vehicle. But what I find and what is pretty known out there is these are notorious for very exorbitant fees. Now, in my realm, I believe a reasonable fee for investing in something would be maybe a 1% to 2% on the high side.
Yeah.
Variable annuities tend to average 3% or higher, and I've seen plenty of them that are in the 4 or above 4% range. That's 4% a year in fees. That's enough to scare anybody off. But unfortunately,
you're going to wipe out a lot of gains in that case. You'd have to make that much more on the upside just to make up for the fees. And then there's downside too. Your principal isn't protected in a variable either, is it?
That's correct. There may be some death benefit protection features, but ultimately, you can erode principal through negative performance, high fees. And then if you're at a withdrawal phase and you have all three of those things happening at the same time, then, this is this can be a dicey proposition. There was a book in our financial industry that Tony Robbins, the motivational speaker, did a big financial book a few years back, and he did a chapter on variable annuities. And I remember, him saying in this book that this was the commission darling of the brokerage industry. So that never comes off very well. So anyway, when I run into these, it's very rare that somebody actually knows exactly what they've got. They either misunderstood what they are invested in or it was misrepresented. But it's pretty amazing to me how few actually are dialed into what exactly did they buy and what is it costing them and how it works. So if you're not going to get fully educated on something, I would also be cautionary for that reason.
Right. Yeah. And that's another big reason to be cautionary. I do know that a lot of these other annuities, you don't have the risk. And so if you're going to have the risk of the market and fees on top of it, in my opinion, you might at that point, why wouldn't you just be in the market? I know there have been reasons and certain instances where variable annuities have worked for certain time periods for some people. But yeah, that's why, you've got the Susie Ormans of the world talking about annuities and all her quotes and people who are down on annuities, the quotes they have about annuities are really based on just that one type, aren't they?
Yeah, you're exactly right. And I've got all those quotes and different articles that I've accumulated over the years. Those are not products that we work with. And you're right. If we're going to be in the market, I think there's more prudent ways to go about it to keep the fees down. And in the past, on one of our shows, we've talked about buffered index portfolios where you could be in the market with the upside, but still have some insulation against the downside. And you're not committing your money for a long period of time either. And that's the one thing that is important to understand is that most annuities are committing your money for a certain period of time. And with that, there's liquidity limitations. Most typical annuities are going to allow you to access up to 10% of your principal value each year without a penalty. In the way that we position annuities is specifically for the safe side of the equation. So when we're looking at a profile for an investor and we have them do a risk analysis, and we have a system where it comes in with a risk score between 1 and 100, 100 being the most aggressive, 1 being the most conservative. So let's just say somebody comes right down the middle with a score of a 50. Okay, that means that half of their money should be allocated to growth and the other half to be safer assets. Sure. Well, the traditional way of thinking is, well, I'm just going to put half my money in stocks and half my money in bonds. Well, bonds are not necessarily principal protected by any means. Bonds
no, over the last few years, they've been a little rocky with ups and downs of their own. I remember 2022, the stock market went way down, and so did bonds. You couldn't make money on bonds or the stock market. So that's rough. If bonds were your safety, certain years that doesn't work out, does it?
No, we don't have to go back too far to look at a year where that didn't go very well, which was 2022. So bonds have an inverse relationship with interest rates. And when interest rates go up, bond values go down. And so in 2022, when we knew inflation was getting the better of us, right? And the Fed's using the tools that they have. And one of the best known ways to curb inflation is to raise rates. So as they were raising rates, bonds were dropping pretty dramatically. And the aggregate bond index in 2022, I believe, was down right around 16%. It was the first year in over 40 years that both stocks and bonds were down by more than double digits. And a lot of people, when they're trying to reduce risk, they'll go from stocks to bonds. And sometimes you could be going from the frying pan to the fire. So we don't view bonds as true principal protection, although it can be, a little less risky, obviously, than stocks. But so with that, we don't want to be overly concentrated in bonds. So if somebody has $1 million portfolio and they score a 50, so a cookie cutter plan would be 50 stocks, 50 bonds. But again, for the reasons we just mentioned, that doesn't always work out well. So what we would consider is to offload some of the concentration in bonds into an income type of an annuity. And that's what we'll talk about next, which is the most popular type.
Yeah. The fixed income annuity or the fixed indexed annuity. I know fixed index annuities they are so popular right now for retirees. And maybe you could tell us why that is. Why are these, in your opinion, the best option?
Yeah. And again, these are not one size fits all either. So before I jump into it, just understand, like, I look at it like this. Every insurance company has the same pie to slice, but they're all going to slice the pie a bit different based on actuarial design and where they're going to concentrate their features and benefits within these products. And so for that reason, it is really important that you're getting the right coaching and education and guidance to make sure that it's a fit for your specific objectives. So when we're talking about fixed indexed annuities, again, fixed means principal protected. Index means it's going to participate in the upside of an index like the S&P 500. And then again, annuity just simply is a contract by an insurance company. But take the word annuity, the derivative there, annuum, means annual income. And that's what annuities were originally designed for. And so that's what we want to use them for. So with an indexed annuity, what they're providing is the upside of the market without the downside risk. Now, we're not trying to compare these to stocks. Remember, we're looking at these as a bond alternative. So we're not going to try to say that it's going to grow like equities would, but ultimately, you can get some decent returns in these products. And so as the market goes up, your money grows. When the market goes down, you're sitting the bad years out. So in a year where the markets go down, you could get a zero that year. And that's sometimes where we say zero is hero, right? Because if you're getting a zero in that, then what are the other accounts in the market doing? They're probably down. So sometimes zero is your favorite return for the year, believe it or not.
Zero is your hero. You've said before, I've heard you say it before, and that's a great point, because if the market's down 5 or like earlier this year 10% and you're sitting at zero, your account doesn't go down because of that. You don't lose money. But if the market goes up, you do get to participate in the gains, yet it's not tied directly to the market, so you don't have that risk.
Yeah, and actually how they do it mechanically is your money's not physically in the market. So when you park money with an insurance company, as we mentioned earlier, they're putting your money in reserves. And essentially what they're doing is taking some of the interest off of the reserves, and they're going to Wall Street and buying a call option on the underlying index. So if the markets go up and the call option blossoms into a gain, 100% of the gain goes back to the policy owners. But if the call option, or if the markets go down, the call option will expire worthless and the reserves continue to protect your principal. And then it resets and does it all over the next year and year over year. So many of these are going to lock in your gains as you go. So if you make 8% one year and you lock in that gain and markets drop 10% the next, you're not giving any of it back. So you're always ratcheting up, you're locking in your gains, and you're wiping out the down years.
Yeah. And that's what we want to do. So if you have some money that you're going to need in retirement, and you have to have a certain amount of money in retirement that is going to be there each and every month. So, you've talked a bit about each of the basic types, the 3 main types of annuities out there that people need to know about. My question for you is, how do you utilize these annuities? Like, let's say that fixed index annuity, how do you utilize that within the plans that you create for your clients? So a client comes to you, they've got a 401k, maybe they've got an IRA, some money in the stock market, and they say, hey, I want to retire in 5 years. How are you going to incorporate annuities for them? Or what do you look at, and how do you do that?
Yeah, perfect. So, so we look at annuities as a piece of the puzzle, and we don't want to over concentrate in any one thing. And so, a typical case, let's work it through this way. So, let's say somebody's got $1 million nest egg, right? And ultimately, they want to build a plan. And so, let's say they come in with a risk score of a 50. So, they're a moderate investor, a balanced investor. So, we need to have half in growth and half in safer assets. So if you have $1 million, right, do we want to put 500,000 in bonds? Well, I wouldn't. That would be an over concentration. So where we're going to position the annuity is we're going to offload some of the bond concentration. In a typical case for us, we might do anywhere from 15 to 30% allocation to the annuity. So on a $1 million case with a 50 risk score, we might be talking about 100 to 250,000 in an annuity. Okay. And so where the indexed annuity comes in is we like the products that build benefits for future income. So regardless of what the markets are doing, there's an income benefit that is growing and building an income bucket, or what they call an income base. And it's essentially using leverage for the insurance company. They're going to inflate your resources at a greater rate than what the market itself may actually do or perform. So when you're inflating resources and you let the annuity benefit bake and cook and accumulate for a number of years, when it's strategically time to turn on that income stream, okay, at that point, you're going to be drawing off of a much larger bucket than what typically the bonds would have generated, or even the principal growth of the annuity. And therefore, you're able to generate far more income using less money. Now, why would an insurance company do that? Because if they make it attractive enough for you to turn this annuity into a personal pension, then guess what? You're not going anywhere. Your money's going to stay put. You're going to keep getting that monthly, that monthly deposit, or what we call mailbox money. And ultimately, what we're trying to do with the annuity is create more foundational income. So that, paired with Social Security, provides us with a greater amount of guaranteed income, and it reduces the reliance that we have on the market and what we need from the market to solve for our income gap.
That's huge. And so that's huge for both. It's kind of a win-win situation. And this type of annuity, like a fixed index annuity, this wasn't around when I was a youngster even. This is relatively new, and they've gotten more and more competitive over the recent years, haven't they?
100%. And I think, index annuities now have about a 20-year track record, maybe even a little bit more. I'm dating myself a little bit, but I was around when these first really started coming out. And like you just indicated, they've really advanced over the years. And now you have specialty indexes, as Merrill Lynch index, a PIMCO index, Bloomberg. There's a lot of different companies that have gotten into this space. And when it comes to growing the money with the upside of the market, there's some of the products are going to cap your upside. So they're not going to give you all the upside because they're not giving you any of the downside.
Right.
Others might provide participation rates where you're not capped on the upside, but you're only going to participate in a certain portion of the market. So again, that's where a lot of these different nuances come in. But what I'm focused on is how is it going to do in terms of solving for the income need as it's pairing with the other pieces of the plan. So we do integrated planning, and one piece needs to help the other piece, helps the other piece. And that's ultimately, I think, a solid plan that is going to account for any scenario, whether it's good times or bad.
There you go. And you mentioned it there, solve for income. And that's the trick. That's the problem. You started the show by saying people are in their accumulation phase, but then they need to move over to their income phase.
Right.
Distribution. And so that's where like a fixed index annuity can really come into play. And again, everybody's different. Some annuities are going to work out better. I know that a lot of insurance companies are now offering hybrid features, like you mentioned. You alluded to a minute ago. Long-term care is a big one because that's very costly. And you can get a long-term care rider that will really help you provide some source of income should you need long-term care. If you don't need it, you can use it for other benefits. Use it in the annuity like you would have without it. So I think that's fantastic.
Yeah, and you actually took the next thought right out of my head there, Tony. So love that we're always on the same page. But yeah, I wanted to bring up the impairment benefits real quick as a kind of a final thought here, which is, so many of these annuities now are incorporating these long-term care alternatives because traditional long-term care is so expensive. And quite honestly, we don't know if we'll ever need it. We could die peacefully in our sleep and never have cashed in on a long-term care policy. So they've incorporated impairment benefits in a lot of these annuity products. And essentially the way they will work, many of them is, whatever income it's guaranteeing you, if you can't perform 2 of the 6 activities of daily living, eating, bathing, dressing, toileting, transferring, continence, then if it's a single person annuity, it will double the income that it's guaranteeing. If it's a 2-person annuity, a joint annuity, it might double, but many of them may only pay 1.5 times the income because now it's insuring on both lives.
Sure.
So this has played out in my career where folks, we position these products in the event that something like that happened. And ultimately it does happen. Many of us age to the point where we need care and we don't die peacefully in our sleeps. And so that's where these tools become very handy to accelerate resources to offset higher cost of living due to assisted or nursing home care.
Yeah. And the stats are almost 1 out of every 3 people now who live past the age 65 will end up needing long-term care at some point. It's like just over 70%. I think 71% I read recently. So AARP said that. So
Yeah, and I think only less than 5% of people have done any type of long-term care planning.
right.
You know?
Right. I mean, yeah, there's a large percentage. I know I was reading a few AARP studies recently, and they talked about how only 20% of Americans that are 50 or over have any money saved for retirement.
Well, that's pretty scary.
And only 5 have planned for long-term care or any type of long-term care plan. So, and yet almost 1 out of every 3 people are going to need it. If you live to 60, once you live to 65, there's a 1 in 3 chance, basically. So,
Gotcha.
and both my parents are there, and my wife's parents. So,
Yeah, we're living longer, but we're
Yeah.
also being kept alive longer through medical advances and things of that nature. So, I mean, you're talking to a guy who likes to plan everything out. So I want to have a plan
Sure.
for that and all the rest. And, lending a blind eye to things is not much of a plan from my perspective.
No. Well, great show today. But before we go, Ryan, let our listeners out there know how they can get a hold of you.
Sure. So you could call in at 615-467-6300. Also, you could check out our website at rsgtn.com or email us at info@rsgtn.com.
All right. Give that second number one more time.
Yeah, 615-467-6300.
All right. Thank you so much, Ryan. And listeners and viewers, thanks for tuning in. That does it for today's episode of More Financial Talk with our host, Ryan Moore.